one of the key things we've been highlighting is that we're cautiously optimistic for many of the reasons that you've mentioned, in terms of geopolitical tensions in particular. That's one of the key things that's on our radar. But if you look just the policy support that has been in place, whether from central banks or from on the fiscal side, that's key. And that's one of the key things that's been driving the markets, and for that, it's important to remain selective. So we do think that it's not, all guns a-blazing, rip-roaring sort of environment. The environment just maintains that you have to be selective. So within Asian markets, we like South Korean equities, for example. We think they'll benefit as fundamentals improve. Another example is Asian credit. The names within that space, they're strong. They tend to be more quasi-sovereigns, and they'll benefit in this environment as well. So it's not an idea of being agnostic within the markets. It's more about selectivity in our view.
Okay, what area of the market do you want to avoid if you believe that geopolitical tensions with China are going to worsen from here? Because day after day we talk about these tensions, but many investors seem hesitant to make a play on it.
So I think for the key thing for geopolitical tensions, and we've seen it how it's played out over with the trade war in the past, is that no one really knows how to play it out. So it needs to be kept in the back of our minds of making sure that we're just ready to dial down risk or manage risk when necessary. So the focus for us is focusing on fundamentals and how they're going to improve over the next 9 to 18 months, and that's looking through asset classes. So obviously you have the geopolitical tensions in the back of your head, but that's where you would have to dial down risk if necessary. But essentially, the focus should still be on fundamentals and fundamentals of asset classes more generally.